Welcome back to the Crypto Intellect, your trusted source for the biggest XRP and crypto developments happening around the world. Today we are breaking down a story that could change the way many investors look at XRP forever. The SEC versus Ripple lawsuit has officially reached its conclusion, major blockchain infrastructure is moving into live production, and new developments surrounding the Clarity Act are creating even more discussion across the crypto industry. While many people continue watching short-term price action, institutions appear to be focusing on something entirely different. They are paying attention to regulation, infrastructure, settlement technology, and long-term adoption. Those are the areas that often matter most before markets react. Before we begin, remember this is not financial advice. Everything discussed in this video is for educational and informational purposes only. Always do your own research before making investment decisions. If you enjoy balanced crypto analysis backed by facts instead of hype, make sure you subscribe to the Crypto Intellect, hit the like button, and turn on notifications so you never miss another important XRP update. One question before we dive deeper: had you already heard that multiple countries continue exploring digital assets for national reserve strategies? Or is this the first time you are hearing about it? Let me know with a simple yes or no in the comments, because what we are about to discuss goes far beyond daily price charts. The biggest story today is not a sudden price spike. It is the combination of legal certainty, growing institutional participation, and legislation that could reshape the future of digital assets in the United States. Many investors focus only on candles and market volatility, but history shows that major structural changes usually happen quietly before they become obvious to everyone else. By the time headlines begin celebrating those changes, large financial players have often been positioning themselves for months or even years. That is why understanding the bigger picture matters so much if you are following XRP over the long term. Let's begin with the biggest headline. The legal battle between the SEC and Ripple has reached its final stage. Ripple accepted the court's judgment, paid the required financial penalty, and the litigation that dominated crypto headlines for years has effectively come to an end. One important legal concept frequently mentioned in discussions is res judicata, which generally refers to a matter that has already been finally decided by a court and cannot simply be relitigated between the same parties on the same claims. Because of this, many legal analysts believe the central issues resolved in the Ripple litigation are no longer open for another identical challenge. That is why so many experts describe this chapter as closed. Even today, social media continues spreading claims that the lawsuit is somehow still active or that XRP remains trapped in legal uncertainty. Those claims often ignore what the actual court decisions established and create unnecessary confusion for investors trying to understand the facts. Perhaps the most significant outcome for XRP holders is that federal court rulings distinguished XRP itself from being automatically treated as a security in secondary market transactions. That distinction became one of the most discussed regulatory developments in crypto history. Very few major digital assets have gone through years of courtroom scrutiny and emerged with this level of judicial analysis. Regardless of where someone stands on Ripple as a company, the legal process provided a degree of clarity that many projects still do not have. Investors continue debating future regulation, but XRP now has a legal foundation that institutions can evaluate using actual court decisions instead of speculation. That does not mean every regulatory question in crypto has been answered. However, it does mean that XRP's legal position today is very different from what it was several years ago, and that difference could become increasingly important as more financial institutions evaluate blockchain-based payment solutions. Of course, many viewers immediately ask the same question. If the legal uncertainty has largely been resolved, why has XRP not exploded higher already? The answer is that markets rarely move in perfectly logical or immediate ways. Crypto has always experienced long periods where infrastructure advances much faster than price action. Investors have seen XRP trade through extended periods of weakness despite positive developments surrounding partnerships, technology, and regulation. That disconnect frustrates many retail holders, but experienced market participants understand that price and fundamentals often separate before eventually reconnecting. Previous market cycles have shown similar behavior across different assets. Markets can remain emotional for much longer than expected, especially when macroeconomic uncertainty, interest rates, liquidity conditions, and broader risk sentiment dominate investor psychology. Looking only at today's price may cause someone to miss the larger structural changes taking place underneath the surface. This is exactly where institutional investors often think differently than retail participants. While many individuals react emotionally to daily volatility, professional investors usually spend more time studying infrastructure, compliance, settlement technology, and long-term adoption. Every market cycle has produced moments where fear encouraged retail selling, while larger participants quietly accumulated positions. That pattern has repeated throughout financial history, not only in cryptocurrency, but also in stocks, commodities, and foreign exchange markets. Institutions generally care less about whether an asset moved 5 or 10% this week, and more about whether the underlying ecosystem is becoming stronger over time. If regulations improve, payment systems become more efficient, and financial infrastructure continues expanding, those developments can matter much more than temporary price swings. That is why many analysts continue focusing on what is happening behind the scenes, instead of becoming distracted by every short-term market movement. Another important piece of today's discussion involves the growing momentum behind the Clarity Act. Supporters argue that comprehensive digital asset legislation could provide clearer rules for companies, developers, investors, and regulators. Rather than relying primarily on enforcement actions, legislation could establish a more predictable legal framework for innovation. Industry organizations have repeatedly argued that certainty encourages responsible investment while reducing unnecessary confusion. Whether every provision ultimately becomes law remains uncertain, but the conversation itself demonstrates how much the regulatory landscape has evolved compared to just a few years ago. Digital assets are no longer being treated as a niche experiment. They are increasingly becoming part of serious discussions among lawmakers, regulators, financial institutions, and global businesses that are exploring blockchain technology for practical applications beyond simple speculation. Supporters of the legislation also argue that blockchain technology is not only about cryptocurrency prices. They believe tokenization, faster settlement, programmable payments, and digital ownership could eventually reduce costs across many parts of the economy. Instead of multiple intermediaries handling transactions, blockchain networks may allow certain processes to become more efficient. That could potentially lower expenses associated with financial transfers, settlement, documentation, and other administrative functions. While those benefits will likely develop gradually rather than overnight, many companies are already investing billions of dollars into blockchain research, because they believe efficiency gains will become increasingly valuable. The discussion has shifted away from asking whether blockchain has utility toward identifying which networks and platforms will capture the greatest share of future adoption. That is an important difference compared to the early years of the industry. Political momentum also appears stronger than it has been in previous legislative efforts. The crypto industry has become significantly more active in educating policymakers and supporting candidates who favor regulatory clarity. Regardless of personal political opinions, one fact is difficult to ignore. Digital assets now represent a much larger topic in Washington than they did only a few election cycles ago. Lawmakers are hearing more frequently from businesses, financial institutions, technology companies, developers, and voters who want clearer rules instead of ongoing uncertainty. That increased political attention does not guarantee any specific bill will become law exactly as written, but it does suggest that crypto regulation has moved much closer to the center of national policy discussions. For investors, understanding that shift may be just as important as following daily market movements, because legislation often shapes investment environments for many years. At the same time, real-world blockchain adoption continues expanding beyond trading. One example attracting attention involves stablecoin payments becoming faster and more practical for businesses and content creators. Instead of waiting weeks or even months for certain cross-border transactions, blockchain settlement can dramatically reduce processing times in some situations. These are not simply theoretical demonstrations inside laboratories. Increasingly, companies are deploying blockchain solutions into live operational environments where actual users depend on them. Every successful implementation strengthens confidence that distributed ledger technology can solve real commercial problems instead of existing purely for speculation. Those small operational successes may not immediately dominate financial headlines, but collectively they contribute to broader institutional confidence in blockchain infrastructure and digital asset ecosystems. Artificial intelligence is also beginning to intersect with blockchain in fascinating ways. Developers are exploring methods of using blockchain technology to verify authenticity, combat deepfakes, secure digital identities, and improve transparency across AI-generated content. As artificial intelligence becomes increasingly sophisticated, verifying trust and ownership may become even more valuable than generating content itself. Blockchain networks could play an important role in creating permanent records that help distinguish authentic information from manipulated material. This demonstrates that blockchain's future extends beyond digital currencies alone. Multiple industries are investigating how decentralized technologies might improve efficiency, security, verification, and accountability. The more practical use cases emerge, the stronger the long-term argument becomes that blockchain infrastructure represents a foundational technology rather than simply another speculative financial trend. Looking globally, digital assets continue attracting attention from governments exploring reserve diversification and financial innovation. Different countries are approaching digital assets in different ways depending on their economic priorities and regulatory environments. Some are experimenting with blockchain infrastructure. Others are evaluating digital asset reserves, while many continue researching tokenization and central bank digital currency initiatives. Although reports about exact numbers of participating countries often vary and should always be verified carefully, the broader trend remains clear. Governments around the world are paying far closer attention to blockchain technology than they were only a few years ago. That growing international interest reinforces the idea that digital assets have evolved into an important geopolitical and financial topic rather than remaining confined to a small community of technology enthusiasts. Tokenization represents another development institutions simply cannot ignore. Major financial firms continue exploring ways to place traditional assets such as government bonds, real estate, private credit, and investment funds onto blockchain networks. Tokenization has the potential to improve settlement speed, increase transparency, expand accessibility, and reduce operational costs across capital markets. Large asset managers are investing time and resources because they believe blockchain infrastructure may modernize existing financial systems rather than replace them entirely. XRP supporters frequently point to this trend because Ripple has consistently focused on enterprise payment solutions and efficient cross-border settlement. Whether XRP ultimately captures a significant portion of that opportunity remains to be seen, but the direction of institutional investment clearly shows growing confidence in blockchain-enabled financial infrastructure. I know many viewers watching today are probably thinking exactly the same thing. If all these positive developments are happening, why does the market still feel frustrating? That is a fair question, and every long-term investor has probably asked it at some point. Markets often test conviction before rewarding patience. Throughout financial history, transformative technologies have experienced long periods where public sentiment remained skeptical, despite continuous progress behind the scenes. Blockchain may be following a similar path. Infrastructure builds quietly, regulations slowly improve, institutions gradually participate. Eventually, markets recognize those changes, but rarely according to anyone's preferred timeline. That is why separating temporary emotions from long-term developments becomes so important. Headlines come and go, but infrastructure, legal clarity, and adoption often create value over much longer periods than daily trading sessions. When we put everything together, today's picture becomes much clearer. The SEC's long-running case against Ripple has effectively reached its conclusion. XRP now operates with far greater legal clarity than it once had. Institutional interest in blockchain infrastructure continues expanding. Stablecoin adoption is growing. Tokenization is moving from theory toward practical implementation. Lawmakers continue debating comprehensive digital asset legislation through proposals like the Clarity Act. None of these developments individually guarantee future price appreciation, and nobody can honestly promise what XRP will do tomorrow, next month, or next year. However, taken together, they illustrate an industry that continues maturing despite periods of volatility. That is why so many long-term observers remain focused on fundamentals instead of daily market noise. The infrastructure continues advancing, regulations continue evolving, and adoption continues expanding. Whether markets fully recognize that progress immediately or later remains to be seen, but the story unfolding behind the scenes is becoming increasingly difficult to ignore. If you found today's breakdown valuable, make sure you like this video, subscribe to the Crypto Intellect, share it with someone following XRP, and let me know in the comments what surprised you most about today's developments. Stay informed, stay patient, and I'll see you in the next video.